Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well.
Morning, everyone. Good morning, Monday. Gosh, what an incredible day down here. Andy Fenton coming live. Hopefully you've got your coffee. I've certainly got mine. It's a cold Monday morning out there. A big shout out to all the Victorians who endured negative temperatures almost across the board on Sunday morning. So there's another record for the Victorians. I was actually out playing golf Sunday morning, and literally the entire fairways were just ice out there. So it's a bit of a cold one. So hopefully you're all rugged up. I'm ready for sort of blizzard material down here. But give us a shout out in the chats. Let us know where you're coming in from. That'll dictate the amount of clothes you've got on, most probably. I'll just open my chat here. Good morning, Joe. Hope you're well. Hope you're well and warm. Luke, good to see you on here again, mate. Hope all is well in your world. While we're letting everyone come on board, just wanted to let you guys know what we're going to run through today. Something I think that everyone should do. The beauty about being in the world of wealth and property and ultimately looking forward into the future and deciding how you want your future to show up. The beauty about that is that we actually have 2 new years every single year. We have Happy New Year for the end of the financial year, and we've got Happy New Year to bring in the new calendar year. So it's Happy New Year for me to you. I wasn't here on the first to share that with you, but Happy New Year. May this year be the best one yet. But like all great things that you need to achieve in life, we need to run a little bit of a plan in order to be able to get there. So I thought today would be a great chance to share with you some rhythms that we use within our business with our clients. This is the way that we think about how to structure a year, not just from a wealth perspective, although that has a significant amount to do with it, but also from just a personal planning perspective. So team, I'll share with you a few little secrets that we use. They're pretty simple, but they're things that every single one of you can and most probably should be doing. Just depends on how much time you want to dedicate to it. Morning, Diana. Oh, from Threadbow. Well, you're definitely going to be a little bit colder than what we were this morning, but you'll be rugged up for it. I actually flew over Threadbow and Perisher coming back from a trip recently, and it looked absolutely magnificent. Mount Buller, I think, was a little bit lacking. I think it needs a little bit of precipitation down there. So welcome to you, Diana. Scott, welcome along. FNQ. All good. FNQ. I'll figure out what the acronyms are. I'm still starting the week. So, team, let's get into it. What are the rhythms that are going to keep you in flow, on purpose, and ultimately get you through where you need to be in life? Well, they're pretty simple. Like I said, we've got some basic sort of planning things that we need to do. But 4 times a year, I think you should be. Here's Scott chiming in from North Queensland, just letting us know that it's nice and warm. You'd be in flip-flops and shorts, wouldn't you, mate? You wouldn't have seen a jacket like this in your life, I wouldn't have thought, unless you were down visiting Diana in Thredbo. So super important. Planning is one of the key metrics in business, in wealth, in life. That when you do it well, it really complements the journey and makes it easier to get where you need to go. If you prefer that sort of quantum walk where you just happen to get wherever you're going by accident, that's cool as well. I probably can't help you, and it's not going to be super useful in the world of investing and property and life in general when it comes to being able to sort of land somewhere near a destination that you aspire to. So anybody who's been in business understands that if you don't have a plan, you're probably not going to have a business too much further into the future. And the same really is of wealth. Like if you start planning earlier, and look, what would be the number one thing that I'd love to make an impact in as far as planning is concerned, is that our kids actually start to look at planning from the ages of 20, 21, 22. If any of you are out there, give us a shout out. If any of your children, or if you're under the age of say 30 and you're watching this and planning your future out. Because ultimately, this stuff is gold, because the sooner you start doing it, the sooner you'll see the results. So anyway, team, let's jump into it. I'll share with you the rhythms that we use in order to create success in our lives and in our clients' lives. And it's also going to retrofit itself into, the cycle of how things operate. So the tax cycle, the natural people cycle, as we call it. And you'll see what I mean as we go along. I'll give you the headline view, then I'll break each of them down for you to be able to do. So if you've got some pens or a bit of pad of paper or an iPad, take some notes. Otherwise, you can screenshot on the phone, or perhaps even look back on it. Oh, the amazing Deb is on the call. Morning, Debs. Hope you're doing super well. Mr. Fenton, yes. Anybody who was at the amazing PRE Property Summit knows that we were having a little bit of fun, and the team were referring to me as Mr. Fenton. So well, class, it's time for planning. So team, this is simply what we use within my clients. We also use it within a business program, but it is absolutely 100% relevant for each and every single one of you. And I believe that each and every single one of you should be deploying these planning rhythms in some way, shape, or form. So don't get scared about it. It's 4 times a year. It's not a long time to plan, but if you do this in isolation, and this is what I mean, you should be doing this by yourselves and then integrating it in with your 6-star team. As I always say, if you don't know where you're going, any road will get you there, but this is about choosing the road which is going to get you to the journey that you're on, that you're embarking on, in order to get the things that you want in your life. So I'll give you the high level, then we'll break them down. So we're over here in July, but I'll start in January. It always makes the most amount of sense. So January is what we usually call our on track. January is where we review our goals, we review our budgets, but ultimately it's that time of the year where people are naturally looking for the year to come. Right? We've had our New Year's Eve, we've had our Christmas, and this is a time where people set their goals. And in my world, I like people to actually hit the goals. Many times in other walks of life, we set the goals at the beginning of the year, don't look at them again, and then nothing ever happens. Here, we want to be intentional, and I'm going to take you through how to set some of those. April is our tax time. There's no point in planning for tax after the fact. We plan for tax beforehand. Usually around about April is when the budget comes out. Now, some people say that you plan after the budget. It depends on how late it was. It was pretty late this year and doesn't give you a lot of time to maneuver around. But somewhere around that March, April time, you should be starting to look at what does the end of the year look like, because the end of the year is closer. You can have a better chance of forecasting what your position's going to be. If you're a professional investor and you're on a salary, you might be able to see whether there's going to be a change next year, or whether there's a bonus, or whether, like this year, there's been a super increase, and how to plan for those things. And of course, July, which is what I'm going to riff on a little bit more in depth today. July is what we call our foundational review. So this is where we look into everything that is your investments, your budgets, and how they actually apply to your wealth. I'm going to break it up. We look at the strategy. We track and measure how we are going to that strategy. And then for those of you who've got self-managed super funds or aspiring to create them, that's when we're looking at our self-managed super fund. We want to get those returns ready to roll, or at least prepped, ready to roll as soon as humanly possible. And then in October, this is where we do our investment review. Now, October is typically when, if you've got listed shares will typically, most of them will have done their audited reports, and they'll be back in your hands, ready to lodge your tax returns and or investment returns. So a great time to start to look at actually how your investment's performing. Every time you have a crack at investing, whether it be in property, whether it be shares, where there should be a goal that's attached to that, and you should track and measure how you're going. In the property world, should you be doing a rental increase this year? Have your interest rates gone up? What's the net yield on your investment? These sorts of things. So team, those are the high level rhythms. So let's break into each of them individually, and we'll go into a little bit more detail so that you know what to do in each of those sections for you when you're planning. Let's have a quick look down here at the questions. Vin, mate, the question you've got there, just like before we crack on. Sorry, Stephen. Vino Glam. Sounds like a version of our Wealth, Wine and Wisdom. So, mate, the 120 to the 135 this year, it's not necessarily the tax bracket, but ultimately it's the when we say 135 is the new 120, it's because notionally, if you calculate, if your taxable income and the amount of income that you're going to pay tax on is 135, it attracts almost the same amount of tax as 120. So the percentage is almost exactly the same. So we've sort of said, well, 135 is the new 120, because that means that your average tax is going to be around about that 25, 26% per annum. That's what we were referring to then. Steve? Is Steve? Yep, I keep on getting confused because there's Vino up there. It's probably a little bit too early for Vino on a Monday morning. All right, so let's crack on. Sonia's arrived as well, so we'll keep on scooting through here. So let's have a look at this month. So when it comes to our foundational review, well, I reckon that because you're pre-planned for the tax year in March, April, now I reckon that you should get your self-managed super fund returns ready and raring to go as soon as humanly possible. So if you've got a self-managed super fund, now is when I'd be looking at. Now is when I'd be looking at. Sorry, team. I don't know why it's doing that. Here we go. Self-managed super fund review. So this is where we'd be doing a review of your financial foundation, and what I mean by that is pre your self-managed super fund, have a look at where everything is sitting. What is my equity level? Across all of my properties that I own. What is my total equity? What is the total amount of debt that I've got on all of those properties? What is the total amount of non-deductible debt or bad debt? Which could be your principal place of residence debt, or it could be credit cards that you've let get out of control. Not if you're watching this show, you'll be smack on the money. But bad debt, where is it at? Good debt, where is it at? What is our net income? Are we in net? Are we in surplus? Are we earning more income from our investment portfolio than we have investment debt? So what is the capital value of our investments? How are our investments performing in regards to our goals? All right, so we just have a quick look at our foundational review. We'll also look at things like wills, powers of attorney, insurances, all of those sorts of things. Make sure that everything that's in your financial sphere is set and ready and is still relevant to you in your situation, because the world is a moving feast. It's constantly evolving. So is your financial affairs. So you should be looking at them and asking, is this still relevant? Is this still the right amount? Should I be putting more in? So we're just looking at the foundation and seeing, or getting a measure as to where we're at. And then if you've got a self-managed super fund, your reviews or your tax will be due to be done around about October. That's after all of the investments have basically reported. Now, one of the reasons that we have the next section in October, and one of the reasons why many self-managed super fund returns don't get done until after October, is because that's when audited returns happen with shares listed on the Australian Stock Exchange. So you've got most of your investment portfolio able to be submitted for tax returns at that point in time. But for now, what we're looking at is we're getting ready for that, right? We're getting ready for that tax time for our self-managed super fund. So we're getting our investment reports or chatting with our professionals, asking them, when those are going to be ready and getting those ready to be sent through, having a look at our investment strategies, making sure that those are up to date, any binding nominations, all of those sorts of things. So this is where you start to have that conversation around your self-managed super fund while you're having a look at all of your investments and just getting a good solid position. Where am I at? And making sure that you keep, like we like to do, all of your stuff in a spreadsheet so that you can look at it, you can adjust it. When it comes to looking at rates on loans, whether you're paying above market, below market, all of those sorts of things. Fortune favors the prepared mind. So October, like I said, October is where most of your listed investments, if you've got shares on the Australian Stock Exchange, that's where most of these will be audited and ready to be incorporated into your tax returns. If you don't know what I'm talking about, effectively, just like all of you, a listed company, so let's just say Westfield as an example, or let's go with everybody knows Commonwealth Bank, right? So Commonwealth Bank, just like you, they have to submit tax returns, right? And they have to have their returns and everything audited by the big players in town. And then those audited returns get submitted, and it's not until those audited returns get submitted until we can actually lodge the tax returns of investments that we've made within those companies, right? So we naturally have to wait to hear. I suggest you get all the planning done for your self-managed super fund now, and then all that happens in October is when those final reports hit, then bang, you're off. You're with your accountant or whoever's doing your tax returns for your self-managed super fund, and you're done, right? But this is also because that period of time is when you're going to have all of the consolidated reports and investment reports and so on and so forth. I reckon this is a great time where you do your investment review. So you have a look at rebalancing your superannuation portfolios. If you've got investment portfolios, you have a look at adjusting those or rebalancing them. You also have a look at all of the values of everything and then calculate the returns on them. How have we done over the last year? How have we done over the last 5? How have we done over the last 10 years? Are we tracking in the right direction? What's our investment return on our properties? Are we making positive gains? Are we making a negative at the moment on cash flow, but positive in a capital? Just keep adjusting so that you know where you're sitting at any point in time. Just do it once a year. Don't need to do it every single day. That'll probably give you a heart attack. But once a year, just have a good calibrate, understand what your total position is. We've already done the foundational review, so you'll have all of the base level numbers in there. Now, the only adjustment on your foundation review is that we're just putting in the numbers, right? We're putting in, okay, well, are we earning good yields? Do we need to be putting up our rents? Do I need to be taking some more risks with our investments? Asking ourselves all of those questions. So as you can see, this could be as long as you want it to be. It could be 15-minute review if you're super organized. It could be 45 to 60. But it's only once a quarter. See, that's the good part. So then January, like I said, this is where everyone does their New Year's resolutions, but I'd be pretty happy if more people were hitting their New Year's resolutions. So what I do with my partner, typically on the 2nd, 3rd, or 4th of January, is we sit down and we review personally. We ask ourselves personally, what are the goals that we had from last year? Did we achieve them? What goals do we want to set for ourselves this year? Now, it could just be as simple as making sure that Leo survives another year as a brand new parent, and making sure that we don't kill ourselves as a result of work and pressures and all of those sorts of things. But we typically sit down and we'll sit down. Well, what are our professional goals? What do we want to achieve professionally? What about personally? What are our relationship goals? We're together. What do we want to make sure that we have together? Then, as a family, what are our family goals? This is the time of the year where we spend time to critically think about it, becoming more healthy, spending more time with each other, spending more time with our new family, retrofit that for you. But this is where we set some really pragmatic goals. But we also, from a financial perspective, we review and track and measure, right? And we track and measure our progress towards last year's goals. So we've written them down, and then we just see, how do we go in comparison to last year? Now, it's not a matter of saying, oh, yes, I hit them, amazing, or I missed them, like boo. But it's actually feeling the rhythms of what you're doing and understanding how you're tracking towards the goals that you're setting. You get, from an investment perspective, you can have investments that are performed out of their brain and are just going absolutely gangbusters, and then you're going to have years where it's not so good, right? But it's understanding where you are, and then you can start to make some goals that relate to that. So here's what I mean: like, if you've got a fairly aggressive portfolio of properties and perhaps they're negatively geared this year, and perhaps interest rates have gone up, like they did. Maybe that's, when you're looking at your life goals, that's where you trim it up and you kind of go, well, maybe we delay that overseas holiday. Maybe we tighten the belt in certain areas. Maybe we start to adjust things a little bit, because ultimately the things that throw people off the goals is that they don't plan for the things that have happened or the things that could happen to throw you off. A classic one is, and this always happens, right? Clients for many, many years used to come along and they say, oh, Andy, it was tracking really, really well. It was tracking really, really well. And then Christmas came along and just screwed everything up. I'm like, well, Christmas comes along every single year. And they're like, oh, yeah, but we, put an amount and we missed the amount. So how much did you miss the amount by? A factor of 4 times. Okay, so you thought that this year you were going to spend 4, but instead you spent 16. And it's, yeah. All right. Well, in any year, have you ever spent 4? And typically the answer is no, right? So we've got to be real about what we're spending. If we want to have proper budgets, proper goals, we've got to make sure that they're relevant. And so making sure that we take the time now in January, where everyone's doing their New Year's resolutions, look at your personal goals and sort of say, what do I want to do for me? What do I want to do for partner, family? And then, professionally and financially, what do we want to achieve? Look at those things and then track and measure how you went from last year to this year, because that's going to be the best indicator for you personally as to what you can achieve the next year. Now, if you're like me, I hate budgets. I can't stand them. I've got 4 different ways of budgeting. And if you guys want to know about that, let us know, because I'll share it with you one day. But my favorite way of budgeting is not to jump into all of the detail of every single cent that you spend. It's to set a goal, set a number, and then, over the course of the year, I'll have a look at how we're tracking, but it's then to measure it at the end of the year and see whether we're above or below that number. So it could be numbers every budget is set by an offset account reaching a certain number, or perhaps it's reducing debt. But it's one number that I look at the end of the year that lets me know whether we're on track or off track. Right? Everything else is where you would look to try and trim things up and make sure that things are working, if that makes sense. Some people love to get down and dirty into the detail and we'll have absolutely everything listed through there. If that's for you, no problem. That would blow my brain up, but we all have different types of brains, right? So it's just making it work for you. So January, setting your personal goals, professional goals, family, partner, wealth goals, and then tracking and measuring to see how you went from the ones in the previous year. And that is when we set our cash flow management strategy for the year. It's as simple as that. And then we get around to tax planning time. April is for tax planning for June 30. The federal budget can impact on this sometimes in some ways. And like we said last week, and we had a little bit of a look at the sliding tax scales, this is where you can make a difference. Perhaps it's where you might prepay interest on an investment property. You might use small business depreciation, the accelerated depreciation method. You might purchase more equipment, things of that nature, finance it in order to manage a tax bill. It might be that you need to do family trust distributions, All of these things happen before the end of the year. You cannot change things after the end of the year. You can just shuffle numbers around. So the impact always happens before the end of the race. And the end of the race of every year is in June 30. So team, that's how we run our planning rhythms. It's really, really simple. Like I said, it could be just a matter of putting 60 minutes into each of these throughout the year. 60 minutes in January, 60 minutes in April, 60 minutes in July, 60 minutes in October. Right. So all that is literally taking the time. It's maybe, missing one soapy if you watch television. Maybe it's missing one lot of news. Who bloody wants to watch the news anyway these days? Half the time they're full of shit and the other half of the time they're wrong. But it's just taking that 60 minutes 4 times a year to calibrate where you're going. I promise you, if you start to follow these rhythms, then when you catch up with your 6-star team, when you catch up with your advisor, when you catch up with your broker, when you catch up with your legal counsel, when you catch up with your property coach, all of those things, when you catch up with them, you will be far better positioned to be able to say, okay, team, this is exactly what we're going to do this year, right? We're well on track. And as a matter of fact, we're tracking in front. So maybe we can be a little bit more aggressive this year. Or maybe it's the opposite. Maybe this has been a really tough year. We're a little bit behind. So what we're going to do is we're going to batten down the hatches and we're going to really make sure that next year is an absolute corker. And these are the things that we're going to do for it. It'll also help you be prepared for your tax reviews, for the time with your professionals, so that ultimately you're one of the first off the rank rather than the last off. Who's been the last off the rank, team? Just by whack it in the chat. Who's been the last off the rank by lodging tax returns? And you go into your accountant and it seems like you're at the back of the queue and it takes months to kind of get any type of result. Whack a Y in the chat if that's been you at some point in time. Because what I've noticed is the best way to get to the front of the queue is to be the most organised and to make sure that you're ready to go before everybody else, because there's typically a lag. Yeah, James is a yes. There's typically a lag, right, before when they can start to do the returns and when people start to get organised. So if you're at the front of the queue, then you're going to get things done faster. You mightn't want to lodge them. Right, you might want to hold off, but having them done so that you're ready to focus on the next thing, always be in front of the game. I've forgotten who said it, but I was watching maybe a doco on surfing, and they were saying that 80% of surfing is being in the right position when to catch the wave. That's 80% of surfing. I'm not sure that I 100% believe in it because standing up has been something that took me quite a long time, and even now still I struggle from time to time. But ultimately, if you are in the right position and you positioned yourself well, then your potential of being able to ride that wave and have a good time is significantly increased. So these are some planning rhythms that you can put in place in order to be in the right position to catch the wave and to be able to ride that wave throughout the year. Just replace 4 different soapies per year, 4 different news shows, 4 different insert, however it is that you spend your time in the afternoons. James is up there. James does it early. Just takes a while to get everything organised. Yep. And but ultimately, the earlier you start to prepare this stuff, the easier it's going to become. And then it'll just become a part of your rhythms. And then the extra little hack for those quantum kids out there is when you start to do this stuff, when you start to plan, when you review and when you actually know where you are, you know where you're going, then the world will most likely conspire in order to be able to make sure that happens. So Albert, if you're listening, that one's out there for you. But ultimately, there's a lot of people out there who I know just set the goals and these things just happen as a result of them spending the time to do it. Whether you believe in that or not, I don't know. That's totally up to you. But I reckon if it increases your chances and it's maybe something that you're not 100% aware of, but you think, well, if there's something in it, let's just do it. So why not? Life is a journey. Make sure that you tick every box and make sure that you give yourself the best chances of success. So team, that's the planning rhythms. I'm going to be back on with you guys a couple of times this week. So I've got a few nuggets to share, a little bit more technical stuff later on in the week, which is in and around sort of tax planning and and the tax rates and the super rates and things that you can start to do now in order to prepare for the year based on what the new rules are for this year, so that you can optimize yourself and make every post a winner. But from me to you, team, hope you enjoyed the coffee this morning. I'll look forward to catching up with you guys later on in the week. Have a great morning and a great week. It's bye from me.
Episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.
Thanks, Mango. I think we're still live.